So this week I want to talk about stress testing your portfolio and actually understanding and getting your arms around exactly how much risk is there in your portfolio. People come in all the time and they've been asked, how much risk are you comfortable with? And the standard answer is always, well, I'm conservative, or I'm moderate, or I'm aggressive, conservative to moderate. But what we want to do is we want to put a number on that, because conservative to one person may mean something completely different than it means to another. So what we always want to do is we want to assign a number. It's called our uncle point, because everybody's comfortable with a certain amount of risk, but if they get over that, well, they either want to exit the positions they were in or move it into something that's going to protect them from loss. So this particular client that we're going to talk a little bit about here in the example, his portfolio was worth $440,000. This gentleman came into the office and we ran what we call our risk assessment exercise. And what it does is it has several different options as to how much risk you're actually comfortable with. This gentleman chose portfolio A. And what that means is portfolio A says, yes, I'm willing to take a potential of 5% of a loss in order to gain 10%. Then it also puts a dollar amount on it. So, okay, I'd be willing to push $22,000 off the table in order to gain 44. Now, the next scenario, or portfolio B, is a little bit riskier. So it says, okay, 8.25% is about the maximum that I could stand to lose and not change my lifestyle in order to gain 16.5%. Portfolio C is a little bit more risk, and so on. So what we want to do is we want to understand, okay, how much are you, the client, actually comfortable with risk-wise? So again, this client here chose portfolio A. So then what we're going to do is from that point, we want to stress test his actual portfolio. Now, what stress testing means is we've got a software program that allows us to look over the last 100 years of the stock market's historical data and project pretty closely how your portfolio, or how each portfolio we're managing, would react based on different economic scenarios. So we've got so many scenarios that I could bore you with the information that we have. But what we've done is we've ran 3 of the most popular ones that people are asking about, or we may be hearing about in debates or on the news, things of that nature. So what we're going to do is just kind of scroll through each one of these. First of all, this is going to be a high-level view on the first page here. We'll go into a little bit more depth as we move along. So the first scenario we're looking at was, what if interest rates start to rise back to a historical normal level of about 5%? Well, this particular portfolio would react by dropping by 18.3% based on that scenario. The next one here is what if we hit that debt cliff? What if we hit that $27 trillion number that we're hearing about, and the U.S. defaults for the first time in history? Now, we all hope that this doesn't happen, but as an advisor, we need to be prepared that if something were to happen like that, that our clients are going to be okay, or as good as they can be. Now, this one here is showing if the U.S. defaults for the first time in history, it would cause a 47.6% decline in the total value of this portfolio. The last one here is what if we went through another scenario exactly like 2008? Now, if we went through another 2008, the positions that are in there right now would cause this portfolio to lose 48% in value. Now, this was very surprising to this particular client because he had said he was a conservative investor. Remember, he chose portfolio A, so he wasn't willing to take a whole lot of risk. But then when we find out what he's actually in, there's a complete mismatch. So what we want to do to show where we arrive at these numbers is we're going to look at the first one there, the rising interest rates driven by inflation. Now you're going to see the economic indicators there. We're showing the U.S. Treasury is projected to be at 4.75%, where it's up 2.88. You can see retail sales are going to fall by 1.44%. Unemployment would rise by 0.5%. And this particular scenario would go from $441,000 down to $360,000, which is a negative 18.3% decline. Below that, you can see how each position that's within the fund or within the portfolio would react based on that scenario. The next one we're looking at is the debt ceiling. So what if the U.S. were to default for the first time in history? Well, this scenario here has a completely different set of indicators. You can see the U.S. Treasury has now bumped the rate up to 6.31. You can see the consumer price index is up basically 0.25%. Gold falls by 28% in this scenario. Home prices fall by 16.41, and you can see this scenario would take the portfolio from 441,000 down to 231,000, which is a 47.6% decline in the value. The last one we're going to look at here is what if we went through another 2008? If this particular portfolio and the positions that he holds within it were to go through another 2008, it would see a 48% drop in value, or go from $441,000 down to $221,000. Now you can imagine the shock that this gentleman had when he said he was a conservative investor, but he's exposed to this much risk. If you're not sure about your portfolio and the positions that you're in and how they would react based on different economic scenarios, make sure you call our office and/or visit our website for your portfolio stress testing.